Well, to me, it smells exactly like what they did in Switzerland, where they're backstopping the Japanese government somehow by saying, we'll cover the interest payments, you do this, you do that, in order to keep the stock market in Japan running. That's code for we're going to financial engineer human nature. If the Fed did not exist, we would not be in this economic problem that we have right now. The math is there to support it, but it's also there to support much worse, because if we head for a depression, it's going to peel back 60%.
Happy Wednesday and welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers, and I brought a special guest, Mitch Vexler, here with us to break down what's going on in the markets. Now, obviously, Mitch, a lot of people are talking about a stock market collapse, so today we'll go into that potential. We'll go into the fact that Japan may have been bailed out. We'll go into the fact that there's massive layoffs going on behind the scenes, especially with Intel. We'll go over the bond market. But before I do that, good morning, Mitch. Thank you for getting up early with me on Wednesday. How are you today?
Good. Everything's good. How are you?
Everything's good, brother. I've already done my prayers today. I want to give the viewers just a quick update on kind of what we're going to do today. One of the things we're going to go over is this index right here, which is a measure of the prevailing liquidity conditions in the Treasury market, essentially saying there is massive liquidity issues in the Treasury market right now. Big shout out to Melody Wright for sending this to me. Now, very interesting, guys, and this is part of the reason why we're making this video. It appears, and this is the futures, the market is not open yet, but it looks like a lot of the liquidity came back into the stock market. Maybe it's time to buy. Maybe there's another bull run. But look at this. I mean, the Dow's back up, S&P back up, NASDAQ's back up, gold is up. But one thing that's not up, and this is really, and Mitch and I covered this live, the VIX is down massively pre-market this morning, down 17.7%. Again, more signals that, let's just send it. Let's just keep investing. Now, also very interesting as well as the 10-year Treasury is going back up 3 basis points, near 4%, not quite there. Now, also something very interesting is we never uninverted. Now, one thing I will note, regardless of that liquidity coming back into the market, Mitch, I did notice the reverse repo market actually was draining. And I think this is maybe a 2 or 3 year low in the reverse repo market. So even though there's still, what appears to be plenty of liquidity in the markets, we are starting to see the markets run out of liquidity. Now, can we start, Mitch? Can you break down for the viewers what happened with Japan? A lot of people are not understanding what happened with Japan, where they bailed out. Did we bail them out? Did they sell the 10-year Treasury? Can you go into what happened as of Monday and what is going on with Japan?
Yeah, the Japanese central bank doesn't have a clue what happened in Japan either. At the tail end of the day, they're the responsible party, just like our Fed is the responsible party, unfortunately, in law at the moment. But when you monkey around with the Treasury, so their banks, Japanese banks, put money into their overnight system, just like we have the overnight repo here in the United States. And they've been on the wrong side trying to cover up what is the bottom line in Japan, which is a shrinking population. When your population is shrinking, there's no mathematically possible way to offset the damage done in the economy by virtue of the bonds being created in the first place. In other words, their debt levels are so great. All this is a global central bank problem refusing to understand the truth of Japan, which is it's a shrinking population. They've created so much debt, there simply is no way out. So everybody is doing what I would call being in cahoots with each other to try and cover it up.
Okay. Do you think that, what happened with Japan and the liquidity drain, the liquidity issue, the cracks that we're seeing in the market, do you think it was a temporary, Mitch, or do you think that this is kind of the tip of the iceberg where liquidity is kind of unraveling? Uncertainty is all over. We're losing trust. We're losing confidence. Now, first of all, I've lost trust and confidence long ago. Okay. I'm just talking about everyone else, right?
These bubbles, and bubble isn't the right word, but you have these gyrations of increasing volatility. But every time the volatility increases, you have to understand what's going on under the hood or try and understand it. But you've got in Japan, just like you have in the United States, you've got unfunded interest rate liabilities, you've got unfunded bond liabilities, you've got unfunded pension liabilities. their economy in reality is no different than any other economy. When you have politicians creating divisions of government that are outspending taxpayer money, and in the case of Japan, a very serious problem with a shrinking population, your bond principal liabilities will not get paid back. Your mortgage principal liabilities will not get paid back. And then it gets even more complex when you realize that the Japanese banks lend money to the US banks, and the US banks lend money to the Japanese banks. So you've got what's called intercompany creditor agreements. And that stuff's all got to get unwound. Then you look at what's going on. Why does our U.S. government keep pumping up money in the M1 and M2 supply? It's all the same problem. It's all related. It's a cover-up. Governments exist, or the divisions of the government, certain divisions of the government exist for themselves. They don't exist for the population, and therein lies the problem. When you start looking at the Fed, okay, if you say back in the Great Depression that the Fed should have existed for a few years, okay, fine, that's an opinion, do what you got to do. The idea that that thing still exists today is complete nonsense. And to prove the point, look at what happened 2 days ago, right? Our interest rates went down massively, yet the Fed did nothing. So the market is saying drop it, and the Fed is saying, yeah, we're not so sure, we'll think about it. Fed hasn't got a freaking clue what's going
on. Mitch, do you think, is it fair to say, through one way or the other, do you think that the Fed had its hand in bailing out Japanese markets?
If I was betting on it, yeah. Is there proof of it right now today? No. Will it surface in the next 30 days? Probably, just like they did with the Swiss National Bank and the Swiss government. Our taxpayer injection that went into Switzerland to save that bank, and that bank ended up getting bought. It was Credit Suisse that ended up getting bought.
How do you think that, the Fed is kind of propping up Japan right now? What do you think the actions are behind the scenes, maybe that we may not know?
Well, to me, it smells exactly like what they did in Switzerland, where they're backstopping the Japanese government somehow by saying, we'll cover the interest payments, you do this, you do that, in order to keep the stock market in Japan running. But you will note that the US dollar, Japanese yen spiked this morning. So they're playing this game of chicken between their currency and the stock market. They're trying to keep the stock market running, which in fact is what we discovered a couple of days ago that they're doing here. And we were live on air, and I stated that it looked like a double bottom. That double bottom was held. I also said it looks like there's a gap there, and that gap may get filled. And as we speak, it looks like that gap is getting filled. It's a technical analysis, but you still have to understand we're not out of harm's way, because until there's a higher high and a higher low in the market for the current market, we're still on a down cycle.
Yeah, I mean, and Mitch, it seems like there are major liquidity issues, but it still seems like there is enough inflation, whether it's in Japan or in our own markets or the reverse repo market. It seems like there's still enough liquidity in the markets to potentially prevent a recession. And I want to shift, if I can, Mitch, to what's going on with Intel. Now, obviously, Intel has announced that they're going to lay off 15% of their staff, 15,000 employees. We don't have a breakdown, I don't think, on where those layoffs are going to be. Is it in the States or not? Now, this is an article out of Folsom, California. I've been to Folsom, Mitch. I've done a video out in Folsom with Johnny Fly, basically trying to tell people in Folsom, like, you guys, there's a lot of new construction here, and these are not worth $1 million, But I remember Folsom. Now, this is what it says. Intel is planning to lay off 15% of its workforce. They're one of the biggest employers of Folsom. These layoffs have massive impacts on localized markets. This goes on. City officials now say they're going to do everything they can to support those impacted. I mean, what are they going to do? Just write a sentence and say they're going to do something? I mean, is that the extent of their effort? I felt like Intel stopped caring about its employees about 10 to 15 years ago. Of course, if you get laid off, you're going to feel that way because it is that way. Now, it goes on. After 3 decades at Intel and Folsom, they're saying these latest round of layoffs illustrates the company's lack of interest in its employees. So again, 15,000 positions. They want to save about $10 billion. And this extends well past Intel. Microsoft obviously cutting jobs as well. Software giant UKG. So the layoffs are accelerating. But Mitch, can you explain to the viewers your definition of where we're at with unemployment, and then also, if you can, for the viewers, I love how you break down recession. I love it. Recession is a decline in activity spread across the economy, lasting more than a few months, visible in industrial production, employment, and real income. Can you go ahead and break these things down, Mitch?
Well, anybody that thinks that we're not in a recession is completely delusional. Now, you can argue what the timeline is when that recession started. But if you go through that definition that I sent you line by line by line, it's clear we've been in a recession at least for the last 12 months. And one of the key factors is declining gross domestic product. And the definition is 2 quarters in a row. Well, like I said, 12 months ago, that's when it started. You could also argue that we've been in a recession, in truth, all the way going back to 2008, 2009, because that's when we had the problems with the banks. And those problems never went away. Those credit default swaps, people don't understand, those credit default swaps still exist. So now, on top of those problems, credit default swaps, and yeah, is there value there? Sure. What is it, 15 cents, 20 cents, 30 cents on the dollar? Who knows? But give or take, it was about 67 trillion in credit default swaps. So on top of that problem, now we have the inflation problem that, although you could say is reared its head in the last 12 months, no, it's been coming up for almost 3 years as a direct result of the amount of money that was pumped due to COVID. So we go from one problem to another problem to another problem, and every single one of those problems has a nexus, and that is the U.S. taxpayer. If that U.S. taxpayer was not funding the government's tinkering, these problems wouldn't exist. And in math, from a quantifiable standpoint, you would have what's called smoothing. Smoothing is, in essence, telling the truth. So you don't have these huge gyrations necessary for the Fed to step in and start monkeying around, thinking that they're going to save a problem, which they can't and they know nothing about because they can't even define it. So smoothing gets rid of all the nonsense when you're telling the truth. If you were telling the truth in Japan, you would not be seeing these gyrations in their interest rates, in their markets, in their currency. Nobody wants to pay attention. So eventually the chickens will come home to roost.
I love hearing from you, especially in the mornings, Mitch. Now, I want to be clear, talking about the recession, staying on that line of thinking, is industrial production down?
Industrial production has been down for at least 12 months consecutively.
Okay. Now, a lot of people will say, oh, we have a low 4.3% unemployment rate, not looking at the health of the labor market, not looking at the trajectory, not looking at full-time versus part-time. How do you feel about the unemployment? Do you think the books are cooked? Do you think we're really at 4.3? Why don't you go ahead and go into the unemployment info, Mitch?
Okay. The books are absolutely cooked. And if things were so rosy, I defy anybody to explain to me how Chicago has lost 240,000 residents since 2020. And when you break down their economy with their unfunded pension liability that can never, and I'm using the word never, be paid back. That unfunded pension liability is a direct result of decreasing economic circumstances, right? If things were growing, then the pension, aside from growing due to employment, would be growing. If employment is shrinking and the pension liabilities are increasing, those things are diametrically opposed, but they're connected to the same point. The economy is disintegrating. Now, does it happen slowly over time at first? Yeah, and then all of a sudden you wake up one morning and you're bankrupt, right? So technically right now today, Illinois is bankrupt. So in truth, if the state of Texas wasn't there to back it, because everybody's federal dollars go into a bucket, and then the federal government assigns certain amounts of money to certain states, i.e. Illinois. But Illinois is bankrupt. So if things are so rosy and the employment is so great, how can you possibly explain Chicago? How can you possibly explain LA, where people are leaving because they can't pay their taxes? See, it's an illusion of legitimacy. There isn't anything legitimate about what these governments are doing and how they're lying. But what they're really doing is just simply propping up a system that's already bankrupt.
All right. What about real income? Okay. Labor market and you were gentle compared to some of the conversations I've had with you about the unemployment numbers. But what about income? Is real income keeping up with inflation?
Again, it's an illusion. So Newsom comes out and says, well, we're going to raise the average wage of the restaurant worker. Well, it sounds good in theory, except you've now had about 4,000 restaurants closed, and give or take, in California due to that increase. Do you know that in downtown Chicago, and I happen to know the chef who's responsible, and so my numbers are accurate. Do you know that they have a dishwasher in a very nice restaurant that's getting $25 an hour? However, around that particular restaurant have been 7 restaurants that have closed. So you can say, great, isn't this wonderful? We're raising all these wages. Well, yeah, you can raise the wages right into a no job. And that is what's happening.
I mean, it's just, I'm just sitting back like, is this the Keynesian economics just falling apart before our eyes? I mean, you can only throw so much money at a problem that's not the actual root of the problem for so long before the whole thing comes crashing down, because you're not, again, like you're saying, you're not confronting the problems, the issues. If I can direct your attention, Mitch, to this chart right here, this is very interesting. Again, Melody Wright, right before we hit record, sent this to me. This is on X Twitter from Jim Bianco. And again, this is the index measuring the prevailing liquidity conditions in the treasury market. So this is, as far as the liquidity issues in the market, the yield to error average is, I mean, it's according to this chart, I mean, this has never been this high before. So it looks like there's massive, stress under the hood, liquidity issues in the treasury market. Can you help break this chart down, Mitch?
A little bit. The problem is you have to look at, like we were talking the other day about the basket of what's under the hood and who's supplying the data. So what they're in essence saying is, yeah, our treasury market is locking up, but where do the treasury notes come from and who's covering them? These are the footprints of big banks, not mom and pop. So the big banks get their money from the depositors, and they get their money from the ability to borrow the bonds. So the question is, which one of those underlying entities and or all of those entities are in trouble? And if that did lock up, you would have an immediate collapse of the Japanese market. In other words, if that liquidity dries up, just coincidentally, like we saw on Monday morning before our markets opened up, that's really why everybody went into panic mode. The VIX had doubled up. Actually, it had quadrupled up. It went from 19 to 52 before the markets opened. So anybody who was an options seller really got smacked hard, and people were jettisoning their accounts. And you saw that when Bitcoin disintegrated, and Bitcoin disintegrated because everybody needed cash in the Bitcoin accounts for the margin calls. The Bitcoin accounts were drained immediately. And that was because of the lack of liquidity in the market prior to that market opening. And it's a good thing that the high frequency traders stepped up and said, okay, enough is enough. And that's when I literally said, it looks like we hit a double bottom, and we did right on the spot. We called it to the tick. The timing was incredible, but it could have gone down. Like if that had broken that night, you would have had an emergency meeting with the Fed, just like I said, and they would have had no choice but to pull the trigger because the market wouldn't stop. If we had hit a 7% down and that market locked up and closed, the Fed would go into emergency. We have a friend that calls it orangutanging, but that's what they would be doing, is wailing their arms around, saying, oh. So,
whose timing, Mitch? You know whose timing is not incredible? Jerome Powell's timing. If I can, let's listen to. I want to go back into the past to remind the viewers what Jerome Powell has been saying this entire time. And so I want to go back, a year or two, and I want to listen to essentially what he told the American people as far as why he's doing the quantitative tightening to begin with. People need to remember this is nothing new. We shouldn't be surprised. Take a listen to this, Mitch, and then I want to get your reaction.
Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, They will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. At our most recent meeting in July, the FOMC raised the target range for the federal funds rate to 2.25% to 2.5%, which is in the Summary of Economic Projections range of estimates of where the federal funds rate is projected to settle in the longer run. In current circumstances, with inflation running far above 2% and the labor market extremely tight, estimates of longer run neutral are not a place to pause or stop.
So he's telling us that price stability is very important and that the way to get back to price stability is pain for the consumer. Obviously, you know, and this was in the past, right? I'm going to show you what he's saying now. But can you explain, what do you think? And I know his job is to lie to us, Mitch. Okay, I know that. I know he's doing a great job at that. He's not doing a good job at lying. Okay, well, the masses are confused. Maybe the masses, but can you go into why is it necessary for the consumer to be put in pain and for job loss in order to get back to price stability? Why is all this necessary, Mitch?
First words out of his mouth is, we're going to get control of supply and demand. Okay, that's code for we're going to financial engineer human nature. And the second you dance down that road, he is so ignorant that he doesn't even understand there is something called push demand and push supply. But that is based on human nature, right? So demand can be pushed into a market that's completely artificial. If the demand by the humans isn't there, then you are financial engineering human nature. And ergo, the existence of the Fed, he literally just made my case. The Fed should have chains put on the door and these people thrown out on the street, because it is they who are monkeying around with the American system. If you cannot trust what's going on under the hood, there is your culprit right there. Very nice guy, probably, everything's great. But the bottom line is, you have no business whatsoever financial engineering human nature. If the demand isn't real and the supply isn't real, then the markets aren't real, and you end up in the mess that we're in. And it's nothing more than continuing to cover up the mess. And until you put a stop to this nonsense, people's lives are going to get ruined because they're going to go bankrupt. And you're seeing it in Chicago right now. You're seeing it in California. There's hundreds of thousands of people leaving because they're financial engineering and monkeying around with human nature.
You know, Mitch, it's not easy to flush the fraud out, is it?
No, but this is what I've done for my entire career, right? So I'm always looking as what's causing the problems, because the truth is, as a developer, I'm only as good as my tenants can pay the rent. I'm just a monkey in the middle. But we have the ability to analyze this, and that's what we see. I mean, this is what we do morning, noon, and night.
You know, speaking of your experience and the fact that you have, you're the best I've ever talked to or ever known as far as being a developer and commercial real estate conversions. Obviously, you're very skilled at that. If I can, I want to direct your attention to another video, Mitch, on Jerome Powell essentially talking about what I believe is other than consumer awareness, the biggest black swan, which is the commercial real estate meltdown. So he's going to go into the commercial real estate. He's going to go into bank runs. And if we can, let me tee this up, and I'll come back to you to get your reactions.
A little bit about the commercial real estate and what's happening there. The Financial Stability Oversight Council's 2023 annual report identified commercial real estate as a financial risk. And the Fed's monetary report also noted commercial real estate prices continue to decline, especially in the office, retail, and multifamily sectors. I'm especially concerned that because of the low levels of transactions in the office sector, prices have not yet fully reflected the true decline in the value. So can you expand on the emerging risks the Federal Reserve has identified in the commercial real estate market, one? And then I'm curious, can you discuss the compound risks identified in commercial real estate lending, particularly at banks with large CRE concentrations and high fractions of uninsured deposits?
Sure. Let me see. I think there are just very, very few transactions in commercial real estate right now, particularly in the troubled areas. So it's not a question of prices still falling. It's a question that you don't have the kind of price discovery. You just have to assume that the prices are very low and have come down a lot. So on commercial real estate, we have a secular change in people working from home. This is one big part of it. That means that in many cities, the downtown office district is very underpopulated. There are empty buildings in many major and minor cities. It also means that all the retail that was there to service the thousands and thousands of people who work in those buildings, they're under pressure too. And banks will have made loans to many of those buildings, not all of them, but many. So this we've known for some years. And so what do? We have identified the banks that have high commercial real estate concentrations, particularly office and retail, and other ones that have been affected a lot. We identify them, and we are in dialogue with them around, do you have your arms around this problem? Do you have enough capital? Do you have enough liquidity? Do you have a plan? You're going to take losses here. Are you being truthful with yourself and with your owners? And so we've been working with them. And so for some time we've been doing that. And this is a problem that we'll be working on for years more, I'm sure. There will be bank failures.
Let's stop there. I mean, he just said we will have bank failures. Another thing that caught my attention, Mitch, is like these sons of guns are working with the banks behind the scenes, trying to figure out how to save them. Meanwhile, as we're getting taxed and beat up, as consumers, a lot of people are worried, Mitch, that the Fed is going to create another backstop to the banks. That backstop, like the Bank Term Funding Program, the discount window, is just going to create more inflation. They're going to stop the bank runs. These prices are going to normalize. It's just work from home. That's why the values are going down. It has nothing to do with the overwhelming prices, right? Can you break down what you see behind the scenes going on with commercial real estate? And will you let the viewers know whether or not you think that will be a primary catalyst to knock us into recession? And I know you'll say fraud is the primary catalyst, but if you can work with me here a little.
Okay, let me see if I can't tie this together. So he starts off saying working from home. What was the cause of people working from home? The pandemic, and I call it a plandemic because this was planned. Everybody knows what happened to Kingwood, but they planned to send people home. It was a mechanism of controlling the population. We're right back to the word financial engineering, but they don't want to talk about the cause. So people ended up working from home, and the truth of the matter is the productivity across the United States dropped 30% right on the spot. So if productivity goes and drops down, that literally shows you exactly what can happen when you look back at how the inflation is being affected and how the recession, the date of the recession, employment drops, productivity drops. So that's one issue. The lack of foreclosures is a whole other issue. We know firsthand experience that there are banks, because we've been asked to rescue a handful of companies recently that were in trouble. In one of those cases, the bank has literally refused to foreclose for going on now 2.5 years. I believe that property will be posted within the next 10 days for foreclosure. But the truth of the matter is it was a horrible situation. The general contractor stole money. The developers raised $18.5 million in equity from Mumbai. One problem after another, that equity will get wiped out. The bank will probably lose $7 million that it had injected because the bank never wanted to foreclose to get to the truth. So that would be the second point. The math of what Powell is talking about, he is completely clueless. It is not the fact that the office buildings are in trouble. It is to the extent that those office buildings are in trouble. And we've done the analysis. We had 2 unbelievably nice buildings come to us, high-rise office buildings, downtown Denver, 387,000 square feet. We did the analysis on them. They were 30% occupied. We ran it out 10 years and said, if we buy them, where are we in 10 years? Well, the truth is they wouldn't generate 10 cents in profit in 10 years. Then we said, okay, the floor plates are too large. What if we notch a C-section through the middle of the buildings? What's that cost? Well, that turned out to be about $500 a foot. Well, that shot that idea down the drain. So in reality, what you are looking at with these buildings are functionally obsolescent buildings that literally have no viable economic use to them. Therefore, they are worth land minus demolition. So either Powell doesn't know this or is hiding it, your choice. Either way, it's not a good scenario. And so these properties that are these office buildings that are defunct. And like if you go into Manhattan, a lot of these office buildings don't have parking. If you go down into downtown Dallas and you look at the 1940s, 50s, 60s, 70s office buildings, they don't have parking. They relied on outside parking garages. They've got so many strikes against them that there is no economically viable way to bring them back online. They're abject demolition material. So, okay, now let's talk about the banks that are associated with those loans. It's not the idea that the loans are, well, okay, we're going to take a hit for 50 cents on the dollar. No, you're going to take these buildings back in foreclosure and you're not going to find any bidders. Good luck.
Yeah.
That's going to happen. Ergo, the Fed is going to have to step in. And if it desires to rescue those banks, that's fine. That's what the Fed allegedly is there for. I disagree, but okay, we can debate that issue. So the value isn't there on the office buildings. On the multifamily, well, let's talk about that for a second. So you've got multifamily that's been built on 5 caps, which means if it's cost you $300,000 a door to build, you're going to get $3,000 a month in rent plus. Now ask yourself this question: how many of those tenants can afford $3,000 a month in rent? Congratulations, Mr. Developer. You literally just built a building with 70% credit risk. Now think about that. Add that multifamily to that office. And then you add to the fact that go and look at the Fed's balance sheet. The SIPC that people think they have on the $250,000 deposit insurance. Yeah, go and look at the Fed's balance sheet. It isn't there to cover it.
Right. Well, Mitch, I mean, it seems like the lenders, regional, small, big, as far as the CRE, it seems like the whole pretend and extend. It seems like they have to. It seems like they cannot foreclose on this commercial property. It seems like if the banks do foreclose on the commercial property, they will report those losses and enter bank runs.
Do you think those losses aren't coming anyway? The only difference is one of timing.
Right.
Right.
Well, right. Timing and being transparent with the stockholders, right?
The longer the timeline goes out, the more interest rate accumulation that will not be paid off. In other words, if you ignore the problem here, okay, it's big. I'm doing this, but it's big. If you ignore the problem in another 12 months, it keeps getting bigger and bigger and bigger. And that's why the saying is, how do you go bankrupt? Slowly at first, and then all of a sudden, you're there.
Do you think the stock market is going to collapse?
Nobody knows the answer to that. In terms of valuations, if you want to define a collapse as a 40% downdraft, yeah, probably. It's extremely, the math is there to support it, but it's also there to support much worse, because if we head for a depression, it's going to peel back 60%. And in a depression, you have to define a depression. I don't want people jumping out windows, right? A depression is about 30. In the Great Depression, it was 28% unemployment. That was pretty bad. This time round, given the add-on of the inflation and the devaluations that are coming, you're probably going to be pushing 35%.
Jeez, man. I mean, and for the viewers, that's in a depression. Obviously, there'll be some type of Keynesian money printing, zero, interest rates. Do you think? And then you know what? It's been frustrating, Mitch. A lot of people are like, they're going to cut interest rates because the economy is good. First of all, why would they cut that line alone drives me crazy. They're going to cut interest rates because the economy is good. Think the bulls that are saying that, think about what you're saying and then explain to us, when has the economy been good and the Fed has cut rates? They don't cut rates in good economies. They cut rates to stimulate bad economies. And then obviously the deficit spending. But and I want to get to our last video about Jerome Powell talking about a September rate cut, and I want to talk about rate cuts, but it doesn't seem like they can stop this, does it, Mitch?
If the Fed did not exist, go down that rabbit trail for a second. If the Fed did not exist, we would not be in this economic problem that we have right now. The Fed, in its entire history, has never been in front of a problem. They are 100% reactionary. The problem is, if you can't prohibit the problem, you don't see it coming, you don't do your analysis, what is the point of you existing? So the idea, well, we're going to raise rates into a lessening economy is clearly going to drive the market in the wrong direction. Again, either they don't understand what's coming out of their mouth or there's a nefarious intent. My position is the Fed shouldn't exist. let the market do what the market does. Let human nature do what human nature does, because that'll give you the truth of supply and demand, not the artificial manipulations caused by COVID. Well, we had to shut down this factory, and then we're going to ramp up this factory somewhere else in the globe. Nobody's got control of what the real supply is, and it's not good because you can supply all sorts of stuff. But when you look at the demand, how can you fill the demand when mom and pop don't have the money?
I mean, that's been my biggest argument this whole time is how are people, you guys talk about sustaining this, even though like, okay, this is a lockdown. This is completely abnormal. We were getting $900 for our daycare a month. I mean, they want to sustain that. They want to normalize that, but it's not normal. It's not sustainable. People, because someone's got to pay for it. We can't pay for it. I want to direct and end us out now on listening to what Jerome Powell is saying about the thing is so crazy. He said a potential rate cut in September. Obviously, the market is like going all in on this. So let me direct you, if I can, to this video and then to get your reaction, Mitch.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut, and maybe that it wouldn't be appropriate to cut. So, if we were to see, for example, inflation moving down quickly, or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier, and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
The market is now pricing in a 50 basis point rate cut in September, 63%. They've adjusted this greatly since Monday, Mitch. So, again, the market is all over the place right now, the volatility. But take a look at December. Now the market's saying about 100 basis points. So it's pricing in mostly 100 basis points worth of cuts right here, 47% chance. Mitch, can you just end us out of here, man? We're almost at 40 minutes. Can you just end us out of here on what you think that the Fed is going to do next as far as their rate cuts or increases?
Let's be real clear. The Fed, what you just heard is, well, if the wind is blowing from the north, my tie is purple, and the sky is going to be blue today, we might think about doing something. You have to understand that you want to answer these questions. First of all, the guy who asked the question doesn't even know his math under the hood, but the Fed's answer was complete nonsense. So what you want to do, the Fed, I guarantee, on Tuesday or Wednesday today, after Monday, had we have broken that double bottom, the following day, the Fed would have dropped interest rates, because that would have meant that this market was literally headed for what they call a lockup. And so if the market hits 7% down, the Fed would have gone into absolute panic, and they would have pulled the trigger at least on a 25 basis point drop, because our market is stating we're expecting interest rates to drop. The market is daring the Fed not to. So the Fed's dancing on a razor blade. It's coming. Now, does it matter? That's a different debate. But the bottom line is the Fed is reacting. Who are they reacting for? They're, in essence, reacting for the benefit of the stock market. The stock market is connected to the banks. We have to do the best we can. And you can debate that. I don't have a problem with somebody saying we have to help the banks, whatever. The banks shouldn't have been in this problem in the first place, right? Look at the percentage of deposits to risk. They don't even do their own due diligence, right? To them, well, they've got used car salesmen on staff. So if we got a little bit of extra deposit money this week, our used car salesman will go out and they'll find a place where to put the loan. That's not a good business.
All right, brother. Well, I definitely appreciate you. We'll get out of here, man. We've been talking for about 40 minutes. Before I go, I just wanted to remind the viewers that the link to the petition, Mitch Wexler's petition, is going to be in my description. If you guys want to help join the movement, fighting corruption, fighting fraud, asking the counties to just use simple math on taxing us, sign that petition, you guys. Read that petition, join the cause. And other than that, you guys, Big shout out to Mitch Vexler. Thank you for your time this morning, brother. I know you're a busy man. And you guys, if you're out there investing in real estate, you guys already know we wish you luck and we hope you win.